Alright, so we're going to look at exercise 13.11, which is related to warranties. Let's go ahead and look at, there you go, warranties in general. I mean, when we sell a warranty or a business sells a warranty, they're they're backing something up, so they're getting cash in advance for something that they haven't earned yet. So we need to know how to account for this. So this is similar to unearned revenue, but we're going to see that it depends on a lot of things, right? So there's two methods we can use. The cash basis method, where nothing is done. Basically, you sell the warranty and then you wait, and then if somebody brings it in, then you recognize um, that transaction as it occurs, right? Um, Expense the warranty cost as incurred. So that method is not considered GAAP, right? It's not considered a good way to do it because we know in GAAP we want to do the matching principle. We want to match expenses with revenue. So the other method is called the accrual-based method. Now, under the accrual-based method, you'll notice that there's actually two ways we can do this. So the first way we'll look at this is where the warranty is an integral part of the sale. So you can't separate the sale of the item from the warranty. Here's a good example of that. This is not the one we're going to work today for homework, but this is just an example where you have the warranty, and you you have the warranty expense, which is $70,000, and then the cash that's from the $70,000 in claims, and then you have the liability. Now let me start over because I guess this just got a little complicated, and I kind of lost my my train of thought there. But what I'm trying to say is, we have in the year that the warranty was done, we had $400,000 that's going to be spent. Right, that's what's estimated at some point. So that $400,000 is a future expense, or future payment that we're going to have to make. So we're going to put that expense in the current year. The amount that we sell or deal with that year, I should say, is the $70,000. So the stuff that we dealt with that year is $70,000. The stuff that we expect to deal with in the future is $400,000. So hopefully I was able to clear that up. But if not, one thing I want you to notice is that we credited cash. Now it doesn't have to be cash. It could be cash, inventory, or accrued payroll, right? In other words, it depends on what they're warranting. Are they warranting work? Then you have a future payroll possibility, right? If their warranty is for replacing it, then instead of the cash, it would be inventory, because they're not giving away cash, they're giving away inventory to replace what happened. Or if they're paying the person, then that's where the cash comes into place, right? If they're paying somebody. So just note for our homework, when we look at our homework problem, right, exercise 11, we want to make sure we use the right account for that. So let's look at this real quick. Seltzer Equipment Company sold 500 Roll-O-Matics, $6,000. They spent $30,000 in the first year, and then we're going to use the expense warranty approach for Part A. So we're just looking at Part A. The rest of the servicing warranties will be $120,000. So for Part A, the cash is the first part. So we made the sale of the Roll-O-Matics. 500 Roll-O-Matics at $6,000 is $3 million. The warranty expense is what we ended up doing that year, right? $30,000 for that first year. Now notice this time it didn't go to cash, it went to inventory. That's one of the common mistakes that students get frustrated with. And that's because we're replacing it. So it could go to cash, could go to inventory, could go to an accrued payroll. In this case, inventory. The rest of it, right, that they expect to have to deal with is $90,000. So it's going to go to warranty expense, warranty liability. Now for Part B, we don't have slides for that. So you can actually find this in the textbook, but it's called the sales warranty approach. And in Part B, what we're saying is that the warranty is actually easily separated, or it makes sense to separate the warranty from the actual product. So the warranties are $160,000. Again, 120 is the servicing amount. So if we go back and we look at Part B, with the sales warranty approach, what we want to do is the sales revenue coming in is not the whole $3 million, because 160 of it is the warranty. So the warranty expense, or the warranty that we sold, we haven't earned yet. So it's an unearned revenue, right? So it's a liability. So the cash is $3 million, $2,840,000 is the revenue from the sale. The rest is an unearned revenue. So the first year, we, did do service 30,000. Now, of that 30,000, that means that we earned some of that unearned revenue because we did what we needed to do. So we want to prorate that. So since we earned 30,000 of the expected 120, then that is a percentage, right? 30 divided by 120, that's going to give us the prorate that we need to multiply against the 160,000 of the unearned revenue, so that we can see how much of that unearned revenue we earned by doing the warranty that we needed to do. Might sound a little complicated, but I think that the calculation is pretty straightforward, and I don't think you'll have too much trouble with it. Take the expense for the year, divide it by the 120,000 that they give you as the total cost of servicing the warranty, right? Multiply that by the total amount of unearned revenue to see what you're going to recognize as revenue for that year on the warranty side. All right, so that should take care of this this problem.